Hey cousins, back with another video. There's a secret phrase hidden somewhere in this video. Spot it and you might be one of the lucky winners. So stay locked in. On today's video, we'll be talking about time frames and their importance in Forex trading. In Forex trading, time frames refer to the specific periods each candlesticks or bars represent on a price chart. They range from the 1 minute M1 to the monthly MN, and each serve a different purpose based on your trading style and your strategy. Scalpers usually focus on the very short-term time frames like the 1 minute, the 5 minutes, and the 15-minute charts. These allow them to catch quick moves and enter and exit trade within minutes or hours. Day traders tend to operate within the M15 to H1 hourly range. Usually these to find setups and manage trades within a day. Swing traders, on the other hand, refer to higher time frame traders. They usually trade between the 4-hour and the daily time frames, allowing them to hold positions for days or even weeks. Then the last are position or long-term investors. They look at the weekly or monthly charts and focus on macro trends. The higher the time frame, the more reliable the signal, as they filter out short-term market noise. However, lower time frames offer more trade opportunities and require sharper execution. A smart trader often uses multi-time frame analysis, combining a higher time frame for the trend direction and a lower one for precise entries. Understanding time frames help you align your strategy, manage risks better, and avoid unnecessary noise. It's not about finding the best time frame. It's about choosing the one that fits your personality, availability, and your all-time goals. Imagine you're watching the price of something like, let's say, gold or currency going up and down like a roller coaster all day long. So knowing your time frame or the time frame you trade on helps you short-circuit things. The time frame is how much time one candle or bar shows on your chart. For example, on a 1 minute chart, each candle shows what happened in 1 minute. On a 1 hour chart, each candle shows 1 full hour of price movement. On a daily chart, each candle shows the price for 1 whole day. So if you're looking at a 1 minute chart, it moves really fast. Great if you want like quick trades and you want to just get in and out of a trade. But a daily chart moves slower because it takes a whole day for a candlestick to form, and it's better for seeing the bigger picture. That's why you have to understand these dynamics. Think of a time frame like a zoom level on a map, right? Smaller time frame like the 1 and 5 is like you're zoomed in. You see tiny price movement and short-term trades. But bigger time frames like the daily and the weekly is more of being zoomed out. You see like the bigger trend and bigger moves. If you're just starting out, use the bigger time frames like the 1 hour to the daily to learn without the stress of fast move that cause anxiety and make your heart beat fast. Then as you get better, you can short circuit to the lower time frames and get more pinpoint entries, and you get better with your trading in the long run. I would like to touch on the fractal nature of the market and time decomposition in trading. One of the most fascinating principles in trading is that the market is fractal. This means that price movements and patterns repeat themselves on every scale. No matter how large or small the time frame is, whether you're looking at the monthly chart or the 1 minute chart, the behavior of the market, how price moves, pauses, and reacts is similar or identical. A fractal system, by definition, displays self-similarities. This concept applied to the markets because the same price structure such as trends, pullback, consolidations, and breakouts can be observed across all time frames. For example, a flag pattern or a double top can appear on a 5-minute chart just as it can appear on the 1 hour or the daily chart. In practical terms, this means that the market can be broken down into smaller units of time. A daily candle is composed of 24 1-hour candles. Each 1 hour candle is made up of 12 5-minute candles. Drilling down further, each 5-minute candle consists of 5 1-minute candles. And if you go even further, some platforms allow traders to view tick charts, that's like the seconds charts, where each candle represents a certain number of trades rather than time. This time decomposition is critical in trading because it allows traders to perform multi-time frame analysis. For instance, a trader might identify the overall trend on the higher time frame like the 1 hour or the 4 hour chart, and then drop down to the lower time frames like the 5 minute to find a precise entry like I normally do. This layered approach helps in aligning trades with the bigger picture while taking advantage of the shorter term opportunities, and also plays a role in risk management. Understanding that the market is fractal also helps new traders grasp that no time frame is correct than another. It all depends on your trading style and your overall goals. A swing trader might focus on the daily or weekly chart, while a scalper might live on the 1 minute chart, but both are trading the same market behavior, just at different levels of detail. In summary, the fractal nature of the market means that patterns and price behavior repeats itself across time frames. Since every large movement is made up of smaller ones, time in the market can be broken down infinitely. This concept is fundamental to technical analysis and should shape the way traders read the charts, choose their time frame, and build their strategies out. Join me on this journey while I show you through all these things I'm talking about in our upcoming episodes, Week and Wins. What are Killzones and why do they matter in trading? In trading, timing can be the difference between consistency and chaos. Many beginners spend hours glued to their charts, jumping in at any sign of movement, only to walk away frustrated, confused, and often at a loss. I used to be that trader, but everything changed when I discovered the power of Killzones. So you might ask, what are Killzones? Killzones are specific time windows during the day when the market is most active and most predictable. These sessions align with the opening hours of major financial centers, especially London and New York. During these periods, institutions, hedge funds, banks, and other large players enter the market with size. Their orders inject liquidity and create sharp directional moves that short-term traders like me thrive on. Primary Q zones are the London and the New York Q zones. The London happens from 8 a.m. to 10:30 a.m. while the New York Q zone happens from 2 p.m. to 4:30 p.m. These are not arbitrary times. They coincide with the start of the London and the New York sessions, the two most influential markets in the world. When these sessions begin, the volume surges and the real price action commences. How Q zones affect price and volume. Trading during Q zones isn't just about being present during busy hours. It's about trading when price matters most. So let's break it down. Firstly, volume. Q zones brings an influx of volume into the market. More volume means tighter spreads, faster executions, and better trade entries. Also, it brings about a lot of volatility. With institutional players active, the market moves with more purpose, price reacts faster, trends develop more clearly, and momentum-based strategies perform more consistently. This volatility isn't random. It's driven by meaningful participation, not noise. It's the difference between executing a trade with confidence and dealing with slippage or missed opportunities. Then the third being market structure. One of the most important benefits of trading during the Q zone is the reliability of market structure. Breakouts are more likely to hold. Reversals happen with conviction. Support and resistance levels get respected. Patterns that often fail in low volume periods become more dependable. When you trade outside these windows, you are more likely to experience choppy conditions, low liquidity, unpredictable wicks, fake breakouts, and in general, just a lack of follow through. It's like trying to surf the ocean when there's no wave. So you basically catch nothing. Why I only trade Q zones? Once I realized the impact of these time windows, I made a decision that I could only trade the London and the Q zone and the New York Q zones. And the results, better trades, more time freedom, and a lot less stress. Here's what changed for me. I started catching higher quality setups. By trading during peak volume hours, I could identify and execute trades that had real momentum behind them. I started avoiding market noise, no more fake outs from mid-session randomness or news-based whiplashes, and so on. I became more consistent. Trading became more of a routine sport, no longer a gamble. I wasn't reacting to the market all day. I was executing a plan, focusing on Q zones. Focusing on Q zones helped me shift from overtrading and burnout to clarity and precision. I no longer need to stare at the charts all day. I just show up, do my job, and walk away, knowing I had positioned myself at the most optimal time. And finally, in trading, it's not just about what you trade, but when you trade. Q zones are where opportunity lives. They offer clean setups, strong follow through, and meaningful volume. If you're serious about improving your trading performance, I highly recommend structuring your sessions around these windows. As always, if you found this video helpful, make sure to like, subscribe, and share. Drop me a comment below as I'll be answering all of your questions. Make sure you do, because I'd love to hear from you. And lastly, I want you to keep improving as a trader, keep practicing and getting better, and always remember to play the game to win. Thank you for being here, and see you in the next one. Peace.